Thank you, Ajay. We'd like to thank NITFP for inviting us and giving us an opportunity to present some of our analytical work. At the very outset, I would like to say this presentation summarizes the work of IMF India team over a period of time related to food inflation, headline versus core inflation debate. So this is a summary of the work we have done at the fund regarding food inflation, core inflation, and other issues. So this is how we plan to present our work. I'll go briefly into the questions of why food inflation is important, not only from the perspective of consumers, but also from the perspective of monetary policy, why we should be thinking about food inflation. Then I will talk a little bit about the related literature, how people look at food inflation, what's the role of monetary policy in dealing with food inflation. And then I'll elaborate upon how and why India differs from most of the advanced economies, because all these questions and all these models have been developed in the context of advanced economies. Then I'll request my colleague, Volodymyr, to talk about our work on what is the implication of all these, which I'm going to talk in the first part, on monetary policy formulation and implementation of monetary policy in dealing with food inflation. And then we'll conclude with some policy implications. So the first question which comes to mind, we all know food inflation, why it is important from the consumer's point of view, but we'd like to think of food inflation, why it is important from the monetary policy point of view. And three things which stand out, at least in the case of India. The share of food in household expenditure is very high. That means people factor in what they're spending on food when they think about inflation expectations, when they think about wages. Second, all the RBI surveys have suggested that inflation expectations are anchored by food inflation. This is the best data available on inflation expectations, and they all point to, because there is one question in that survey which asks people what anchors your inflation expectations. And above 90% people say it's food inflation, and it's not very surprising given that people are spending roughly between 40% to 75% of their income on food. And then inflation expectations feed into wages. This is a classical macro theory when you are looking at wages, and if you are spending 70% on food, you try to factor that in when you are negotiating wages. So let's get into some theoretical background, how people have thought about food inflation and the role of monetary policy in dealing with food inflation. The typical or the standard argument is that food prices are transitory and volatile. They are non-monetary in nature. So theoretically, monetary policy should not be doing anything to address food inflations because they are transitory, they will be taken care of. The first round effect should not be at all. Central bank should not worry about them at all. If you look at some of the theoretical models people have built to explain or to elaborate this point, two of these papers are seminal in a sense. They looked at this question whether headline inflation targeting is better or whether it's a core inflation targeting. And Goodfriend and King, 1997, and Aoki at Bank of England in 2001. So they have come up with models where they have argued that if monetary policy or the central bank targets core inflation, that is equivalent to maximizing welfare, and they need not even worry about stabilizing output gap because just targeting core inflation is enough. It will stabilize output gap too. And the basic idea behind their results, or what drives their results, is that markets are complete. So in a complete market scenario, only friction in these models come from price rigidity. So if a central bank wants to maximize consumer behavior, they should try to replicate flexible price equilibrium. Why complete markets matter so much? Because then they have a representative consumer and only aggregate shocks matter because people can smooth their consumption over time. However, emerging markets, and India is one of them, are very different. There is a growing evidence that food inflation has a very different dynamics in emerging markets and low-income countries. So the first point raised in literature why food prices should be ignored is that they are transitory and volatile. So they die out. Central bank should not respond to the first round, let it go. However, Walsh, who was on the India team before, in his work has found that food inflation is much more persistent than non-food inflation in EMs, and they propagate strongly into non-food inflation. Similarly, RBI, especially work by Subir Gokarn, the XDG and others, and also talked about this morning in several of the presentations, that some of the food inflation is not purely supply side, it has demand component to it. So just on pure theoretical grounds, India is so different from some of the models which I talked about, which have to a large extent shaped the thinking of central bankers in advanced economies about how to deal with food inflation and whether headline versus core, what is the right index to look at. On pure theoretical grounds, markets are not complete in India. There is a huge proportion of population who don't have access to formal credit. So on top of, if somebody is doing a modeling work, especially a general equilibrium model, and they only have price rigidity as the only friction, probably that doesn't capture India, because you have on top of price rigidity another friction, which is that markets are not complete. So some of the consumers cannot smooth their consumption over time. Similarly, the other implication is when markets are not complete, aggregate shocks, instead of aggregate shocks, is the idiosyncratic shocks that matter for consumption decision. So what matters for an individual when he's deciding is the composition of household expenditure. If he's spending a lot on food, his expectations, his wage, bargaining, everything depends on the idiosyncratic shocks to which he is exposed. And another thing which all of these models miss, that elasticity of food substitution is very low, especially for people who are in the lowest four deciles, I will say. Some of them are at subsistence level. For them, elasticity of substituting, if food prices go up, they cannot literally substitute away from food. They are spending a lot of money. A major proportion of their expenditure is on food items. All these have implications for the role of monetary policy, or how we think about headline versus core, whether we should completely ignore food, or how to design a monetary policy framework. Just to give a simple table which shows that in general emerging markets and including India, on an average household expenditure on food item is roughly 40%, as compared to advanced economies where including food people eat outside the home is around 10%. So this is a major difference if we are just trying to look at some of the models from which are developed for advanced economies and trying to use them for formulating monetary policy in India. The other table I want to show, this is from World Bank, Finance for All database. The share of population with access to formal finance, as you can see, on an average, 44% people in emerging economies don't have access to formal finance. So only 44% people have access to, I beg your pardon, and 94% people in advanced economies. So the idea that only friction in the economy is price rigidity, which is a cornerstone of all these models by Aoki, Goodfriend, and others, does not hold in EMs. So what I have tried to give you just a flavor of literature, how people think about these issues and why India and other EMs are different from advanced economies, and what does it imply for monetary policy? So high persistence implies that this may lead to misspecification of inflation and may result in policy mistakes. This is the work done by Jim Walsh at the fund. And financial frictions, large share of food in households' consumption basket, low elasticity of substitution. This is the work I did with Ishwar Prasad. If monetary policy ignores food inflation, then it results in a suboptimal outcome. So the question is, what should be the role of monetary policy with all these characteristics, in an economy with all these characteristics? Even though people fully agree that monetary policy should not respond to the first round effect, but there is a complete, I will say most of the people agree that central bank has to respond to the second round effects of food inflation. And given all the characteristics I've listed, we expect the second round effects of food inflation to be much higher in India as compared to advanced economies. If you recall, a couple of years ago, Bernanke made this famous argument that monetary policy in the US does not need to respond to food shocks because second round effects are almost negligible. But we are in India, which is very different. The economy, the structure of the economy is very different, and we expect second round effects to be very large. And if second round effects are large, then monetary policy has to respond to the second round effects. And that leads to the question which I will pass on to my friend to explain how important are the second round effects, because I have just given you a flavor why second round effects may be large. So Volodymyr will discuss about.
So basically, having established that the theoretical foundations and also the stylized facts of Indian economy clearly point to the importance of food inflation, and the natural question is, what does monetary policy have to do? What should be the appropriate nominal anchor for monetary policy? Is it core inflation? Is it headline inflation? If we think it is headline inflation, that we really need to understand of how important is the pass-through from food inflation to headline inflation, whether the core inflation fits. So there are, before we go on to sort of establish in a full-fledged general equilibrium modeling for inflation and for the role of monetary policy, we would like to basically answer very simple empirical questions of to what extent there is a pass-through between food inflation and inflation and core inflation. So we ask two very simple questions. The first question is, does headline inflation revert to core inflation? In simple words, if the answer is yes, basically if headline inflation reverts to core inflation, then the impact of food inflation is temporary and second round effects are probably limited, something that is like the case in the United States. But on the other hand, if the answer to this question is no, basically if headline does not revert to core, then shocks are either persistent or second round effects of these shocks on the core inflation are large, and clearly the mechanism is that it is through higher inflation expectation, it is through the link between wages and prices. So after that, the question is, does core inflation revert to headline inflation? In this case, if shocks to headline inflation, such as those caused by commodity price shocks, they would feed into inflation expectations, price setting, fueling core inflation to pick up together with headline inflation. So the simple empirical way to test it is to follow the framework established by Cecchetti and Mosner and also Clark, and we apply this empirical strategy to India, and we look at monthly data between 1997 and 2013 and the econometric specification that allows us basically to see if headline inflation is reverting to core inflation. And I have to say that we've done this analysis both on CPI and WPI inflation, and the results are statistically as strong and empirically as significant, suggesting the importance of second round effects. So we start with a very simple hypothesis of whether the coefficient beta on, let me explain maybe in a little bit. On the left-hand side, we have a change in inflation, in a headline inflation between a year ago and today. And on the right-hand side, we have a sort of an intercept, which here is meant to model for shocks that are persistent, something that has been there for some time and may not be just transitory. And the term, which is a difference between headline and core inflation, is capturing the gap between the two inflation measures that was a year ago. So the hypothesis that we are starting with is whether this coefficient beta equals 0, which would correspond to a situation where headline inflation does not revert to core inflation. And the hypothesis of beta 1, beta coefficient beta equals to -1, which would be that headline inflation was basically fully reverting to core inflation. And what we clearly find is that we cannot reject the hypothesis that headline inflation does not revert to core inflation. On the other hand, we reject that headline inflation reverts to core inflation. So clear implication of this is that either food inflation shocks are very persistent, they stay, they are affecting inflation expectations, wage setting, or that there are important second round effects. So having answered this question, of course, we are going to sort of next question. Does core inflation reverts to headline inflation? And here we find that this sort of a very similar strategy, but on the left-hand side we have a change in the core inflation between today and a year ago. And we find the coefficient on the sort of inflation gap of -0.8, and it is very highly statistically significant. So this allows us to conclude that core inflation is actually reverting to headline inflation. In other words, if a year ago the headline inflation was higher than core inflation, that today we are likely to see a core inflation catching up to that gap. And with this sort of magnitude of the coefficient suggests that a big part of that gap is being sort of caught with over the last year. These are very sort of simple statistical tests, but what we see is that for the monetary policy to take proper care of food inflation shocks, which are clearly not transitory in the case of India, it is more appropriate for monetary policy to focus on headline inflation as a nominal anchor. And in the next step, we actually try to do a sort of full-fledged dynamic stochastic general equilibrium analysis where we adjust some of the fund traditional monetary policies analysis toolkit for specifics of Indian economy and the presence of the strong pass-through between headline and core inflation. So it's I just give a overview of the modeling framework just to give you a flavor of how we do it. So it's basically a two-country small open economy world model where we have the rest of the world and we have also India. So there is behavioral equations that describes the developments in the rest of the world and also in India. But there is a link between the two, and to put it simple, what happens in India is simplified not to affect what happens in the rest of the world. So India is not a small, of course, economy, but for modeling purposes we take what happens elsewhere as exogenous. So the key variables that matter from the rest of the world are, of course, the developments in output, the developments in interest rates, and the developments in inflation. And the channels of transmission to India are, of course, the exchange rate, the extent to which, say, monetary policy elsewhere affects monetary policy in India through sort of exchange rate appreciation, depreciation. The model is set up in gap terms. In other words, we think of some underlying equilibrium dynamics, whether there is a potential growth, whether there is a sort of trend inflation, and to the extent that there is a deviation from, say, output from potential output or inflation from trend inflation, the model is picking up those changes. And the unique feature of the model and framework is that we allow to, we incorporate this important channel of pass-through between food inflation and core inflation, and we adjust the sort of behavioral equations for price setting, basically to have this term that our inflation equation for core inflation in particular is features this pass-through term for a gap between core and headline inflation. So it's so more formally we basically have 6 equations, but the one that I just was trying to describe is the sort of third equation here, which is the equation that captures the pass-through. So we have 2 kind of separate equations, one for food inflation, one for core inflation, and the focus of core is, of course, on the pass-through. So the key results that we find in our model is basically that in India, inflation, and by inflation we mean the headline CPI inflation, is backward-looking. In other words, that what happens to inflation today, to a large extent, is dependent on the inflation that was before. Of course, one simply cannot ignore here the role of inflation expectations, which we don't explicitly model. We model them through rational expectations, but we don't actually take into account the, say, RBI inflation surveys. But I think what Rahul also pointed out, and what is also clearly indicated in the Urjit Patel committee report, that there is a very important and statistically significant link between food inflation and inflation expectations. So to that extent, this mechanism is clearly present in India. And backward-looking and highly persistent means pretty much the same thing, in a way that inflation today, to a large extent, depends on inflation tomorrow, to a large extent, depends on inflation today. And we also find in this sort of more comprehensive modeling framework that the pass-through between core inflation and headline inflation is important and is very statistically significant. Our model is done on a quarterly data, and we estimate this sort of coefficient on the gap between core and headline inflation to be about 0.3. But if we were sort of to translate it into annual data, we would get pretty much the same result as we were getting with our very sort of reduced econometric, with our very first sort of empirical tests of the sort of pass-through coefficient. We basically find that within general equilibrium framework, a pass-through coefficient for at a 1-year horizon is about 1.8. In other words, in a year, most of the sort of gap between core and headline, core inflation is catching up to the headline. We also find a role for confidence factors in the economic and in economic activity. In simple terms, that means that economic agents, they think about, in deciding on, say, the economic activity today, they take into account the confidence factors, the policy uncertainty factors, about how they think about tomorrow in producing today. It has important policy implications, given the recent economic slowdown in India, that repairing confidence is something that is very critical at this stage. We also find that exchange rate impact on output gap is relatively small. And one clear background fact is that the trade elasticities in India are relatively low. So we've seen some adjustments recently in the current account, but it is likely that that happened not into a large extent due to, say, exchange rate depreciation, but because of other measures, policy measures pursued to contain current account deficit. And we also find that the interest rate in a monetary policy reaction function is highly persistent. In other words, there is a strong smoothing in policy rate setting, and this is in line with other emerging markets, as the emerging market economy. What we also find is that the monetary policy has a role of output stabilization, and our estimates for, say, output gap coefficient in a monetary policy reaction function are broadly in line with other emerging markets. But that basically allows us to conclude that the monetary policy setting in India de facto is not just about inflation, but it's also about stabilization of output. And the key conclusions of our work is that second round effects of food and fuel to core inflation are important in India. That clearly means that the proper focus, the proper nominal anchor for monetary policy is headline CPI inflation and not core CPI or WPI inflation. We also know that inflation is persistent. We don't really look into channels of persistence, whether it's inflation expectations, whether it's wage price setting. But what that means is that if you have a very persistent inflation, then there is a strong need for monetary policy to bring inflation down, including through its impact on inflation expectation. I think what RBI surveys, and not just RBI surveys, but also consensus forecasts point that inflation expectations in India have been running in double digits for some 3 to 4 years. The inflation expectations that we are looking at, these are household inflation expectations, point to inflation of some 12% over the next year. This is clearly a very important channel for monetary policy to basically to reduce inflation, reduce it durably. And another important factor is, of course, that our view is that output gap in India may not be that huge to alone take care of the inflation dynamics in India. And in that sense, we think that it is very important for other policies, structural policies in particular, to help bring inflation down. The clear channel of it, in our view, is supply bottlenecks. Removing, eliminating them will help bring inflation down. One thing that we don't explicitly model, but we are of the view that there is a flattening of the Phillips curve. So the output gap alone is not helping as much to bring inflation down at this stage. Thank you.
We have some time for questions. Yes, Sonal?
I mean, the issue of pass-through from food to core, one of the reasons, I mean, inflation expectations may have a role, but the other reason is also now the fact that rural wages under NREGA are indexed to CPI inflation for agriculture. So automatically the food shock translates into CPI, translates into wages, and therefore translates into service price inflation being high. So if we have to bring down core inflation, despite food shocks and despite this indexation, then what you're saying implicitly is that actually quite significant amount of demand destruction would be necessary. That you overcome the indexation and still get real wages to actually come down. is that something practical? So is that what you're saying, and is that practical in the current environment where, the banking sector is also under stress, so the financial stability concern can actually start to grow?
I think the very important issue is about the credibility of inflation reduction. And the channel of inflation expectations is not just about the sort of the price-wage connection, but also the credibility of monetary policy going forward. This doesn't necessarily have to do with, say, action on policy rate, but a lot on the sort of the communication. And in that regard, these are what we've seen recently is clearly helpful. But having said that, it's clearly the output gap may not alone bring down inflation, as you point out in that regard. So there is alone, burden on monetary policy alone would be probably too high if we were to bring down inflation very quickly towards very low digits.
Just to add, that's exactly the third point of the conclusion we are making. The burden on monetary policy could be significantly reduced if structural policies happen side by side to raise potential, so that your output gap opens up significantly, not only through monetary policy, but by raising potential. So there are two ways of opening up. But in the absence, and you want to durably reduce, this is the pain which the economy has to go through. And given that inflation expectations are entrenched in the sense they are above 10 or 12 for a long period of time, and also inflation is very backward looking. In the absence of what Volodymyr said, the credibility and other stuff, yes, it's a painful situation.
Sure.
From your you've seen other emerging market economies also. So, the framework that RBI is looking into is talking about 6% also. So, if the starting point is a negative real interest rate, how easy, given your experience from other emerging markets, is it going to be to get from 8 to 6?
Well, in the Patel Committee report itself, when they have given out this framework, they mentioned that from going to 6 will require some other actions, which requires the government to curtail its fiscal deficit, which requires this administered prices to go away over time. So there are preconditions already built in the Urjit Patel Committee's recommendations, that to go from the current level of inflation to 6% in 3 years or 36-month window, there need to be some supportive action from the government. That's exactly what we are saying. If monetary policy has to be more effective with less pain, something has to give, and that something is the supply bottlenecks have to give. You have to address these supply bottleneck issues. Related to the point which Volodymyr was raising about, you talked about financial stability, which is very important, but our related work, just for the information of everybody else, we just presented just 3 or 4 slides of our model, but most of it is available in the selected issues chapter or the staff report which came out on the 20th. So anyone interested can go into detail. There is one chapter where we have looked at the recent investment slowdown. We are trying to disentangle what are the reasons. And in line with the RBI studies, we find that real rates have played only a minor role. Roughly a quarter of the investment slowdown has been affected by real interest rates. But we find a significant portion of the current investment slowdown could be explained by looking at policy uncertainty index or looking at NCER business confidence index. So just cutting rates without removing these bottlenecks probably may not result in a massive new investment coming in. So that has also to be borne in mind.
If I may add just 2 points, is we clearly see inflation as India's key macroeconomic challenge. And it has to be reduced, and there will be no sustainable growth without inflation reduction. It's also an important factor for financial stability and for external value of the rupee. So this objective is clearly sustainable, is clearly important. Now about the numbers, I mean, if you look at simple sort of average inflation over the last 15 years or so, it's about 7%, both for food and headline inflation. But a lot of the 7% is due to this 10% inflation about that we've seen in the last 4 or 5 years. If you look back, it was probably around 6%. So going to 6% is something that is clearly in line with sort of historical averages. But important progress has to be made on sort of structural front, on fiscal front, for inflation to be sort of reduced to lower levels. And I think that's clearly recognized in the Patel Committee report in that sense.
The 6% number, just last point to add, why 6%? There was an RBI study, an IMF study done in 2010, if I recall correctly, where we found that inflation above 6% hurt growth. So 6% is kind of that number, which is part of our staff report of 2010, which is also, again, RBI did the similar studies and they found 6 to 6.5%. And even the Patel Committee report has an appendix with similar kind of, so I think 6% is a number coming out of basically the trade-off between inflation and growth.
Surjit, you want to say something?
Yeah. You know, I have no problems with the study, and I think your results are compelling and make a lot of sense and nice framework to look at core inflation and headline and reversion back in a pooled cross-section time series framework. So I have absolutely no problems, and I think it's quite good. What I think you need to answer is, what does your model have to do with India and Indian inflation? You know, there is, if you will, 200, I don't know, 150, 160 countries. I don't know how many in your sample, maybe 100 countries in your sample. And I don't think what you observe in India, you observe anywhere else in terms of the whole administered prices feeding through. Food, as you yourself showed, food consumption is high. Indonesia, China even 37%, and so on and so forth. So how is it applicable to India? And a couple of follow-up questions to that is investment slowdown that you mentioned that you don't find monetary policy. Now, you know, are you using, what inflation rate are you using for your real rate of interest that the producers are facing? I would suggest that the borrowing rate is something like 16%. CPI inflation is 10, and the manufactured inflation, the so-called WPI core inflation, that is about 2 or 3. So on what basis do you make the assertion that really interest rates didn't have anything to do or didn't have much to do with that? And let me just conclude with what will you say? And this was a question I asked Thomas last time. You have that in your conclusion, if you just go back to that slide, just one slide, that the, I have no problems with the first one, because I think it doesn't apply to India. Inflation is persistent. Monetary tightening needed to bring inflation down sustainably, and burden of monetary policy could be reduced if supply bottlenecks are addressed. Now, I'm only concentrating on food inflation, which, as you yourself admit, is a major part. Last I heard, there aren't any supply bottlenecks in food. I mean, food production this year is growing about 5%, 4.5%, which is one of the highest it's been. And basically over the entire period, as I showed, you know, food output has grown at, agricultural output as 3.5% or so, somewhat slightly higher than our average. So what are the food bottlenecks that you see are happening? And, you know, what happens if inflation does decline, and it's a forecast, so it can either decline or not decline. Let's assume it declines, and clearly you are arguing for monetary tightening in order for it to decline. If it does decline in a sustainable fashion, I'm not talking 1 month or 2 months, let's say over the next year it declines to 6%, then what would you say about the RBI, not the RBI/IMF policy of monetary tightening. And last but not least, in terms of inflation in India, you go back from 1950 to 1995, basically inflation was 8%, plus minus, 3-4% up, and never much down. But the average rate of inflation was 8%, regardless of the indicator you used. Then you have from 96 to 2007, regardless of the indicator you use, food inflation, GDP deflator inflation, CPI inflation, WPI inflation was around 4 to 5%. So, in other words, whether it's the RBI saying revert back to 6%, if we have to use if we have to explain the impending decline or non-decline of inflation, you've got to explain what happened in India in 96-2007. Why was it so radically different than either before or after? So basically, bottom line is, you've got a very good model. It has nothing to do with India.
Well, thank you for your comments, and I will like to answer a few of them based on my limited knowledge about Indian inflation. What happened prior to 1996? So on your first question, the regression analysis which my colleague showed was for India, so it's not across country. So it does look at the Indian inflation. Number two, fund has done a lot of cross-country work running similar kind of regressions for Latin American countries. It's a working paper in 2011, and they find that this happens in economies more often which have high food share in consumption basket and where inflation expectations are less firmly anchored. So this is the finding of Latin American countries. Similar analysis has been done by ADB, Chong Yang Ri, who was chief economist now here at the fund, for Asian economies, and they find similar kind of relation. So India may be unique in different ways, but on some of these characteristics, other EMs also have similar characteristics where food is a large share of household consumption, where inflation expectations are not fully anchored in the sense they are high, so they are anchored, but they are anchored at 12. So this result is the numbers which Volodymyr showed were for India, and we find similar. IMF studies have found. It's the two Ciketty framework where he was talking about whether headline goes back to core or whether core goes to headline. And the first cross-country was done by Ciketty. It's a BIS working paper where he looks at all the EMs and he looks at advanced economies and he finds differences and he tries to explain. So that's another source.
I think what's important is that these are the facts, empirical facts, that monetary policy simply cannot ignore. We are not denying that there are important structural impediments to durable food inflation reduction, and clearly the administrative rate settings, the rural wage schemes are factors. So this goes without saying in that sense. And about the inflation rates, I mean, if you look today at major emerging market economies, India clearly stands out as having one of the highest headline inflation rates in the world. If you go back to the 60s, I think we were looking at very different inflation rates, not just in India, but also elsewhere. If you take example of Brazil, where it was some 15 years ago and where it is today. So there is a clearly need for, monetary policy role in this sense.
Trying to say is, irrespective of what country we are looking at, there's a general consensus that monetary policy should react to the second round effects of food and fuel. There's a broad consensus on this issue. So we are asking a question, how big is the second round effect in India? If it's not big, then monetary policy should not worry. If it's big, then monetary policy has to take that into account. And that's why we looked at first, based on all the features or all the characteristics of the Indian economy, do we expect this second round effect to be big? So we looked at two simple equations, whether headline goes to core or whether core catches up with headline. just to get a sense or a feel whether second order effects are important in India. We find that it is. And when the second order effect is large, we thought, okay, let's estimate the second order effect, because everybody talks about second order effects. So why don't we try to estimate using a model which is tailored to the Indian economy, using Indian data, using Bayesian estimation. And we find that this second order effect is substantial, it's large. And then monetary policy has a role, even though it can give it a pass, the first round effect, but the second round effect they have to respond to. So that's all we are claiming in this paper.
Your model of reverting has no monetary policy in it. There's no interest rates in it. Nothing. It's basically, I have no problems whether the headline comes to core or not, but I don't think one should connect it to monetary policy. Second, because there isn't, unless it is there in the equation, and I'd like to see that. Second is, you didn't answer my question about the investment slowdown and the real interest rate. What did you use? And whether the interest rate you used was appropriate, the real inflation measure that you used was appropriate.
No, so you're right. The two equations which we took from the Ciketi framework, we don't look at monetary policy. We just look at two inflation series. We look at the dynamics of headline and core. And we want to see, we ask very simple question. It's a very simple question. If headline goes back to core, that's what people should expect. If food shocks are transient, headline after spiking should go back to core. If not, then two things are happening. Either the shocks are persistent, which is keeping headline away or off from going back to core, or second round effects are important. That's why we ask the second question. If headline is not coming back to core, is it that core is going to headline, going up to headline? So this is, so monetary policy, we have abstracted from monetary policy because we just want to test for ourselves whether second round effects are important. As you rightly mentioned, some of the results which are true for Latin America or other countries may not be true for India. So we have not taken it blindly because Indian economy mirrors some of those economies. So we said, okay, let's test it on Indian data and see if it holds. And only after that, otherwise the whole exercise is futile. If second order effects are non-existent or small, then the whole modeling exercise is futile. And instead of taking results from other papers, we thought, why not we use it? On investment slowdown,